Hello and welcome everyone. My name is Yasir and today we will discuss Unit 1 of our business taxation course, which is be able to calculate tax for the self-employed and complete self-assessment tax returns. Okay. So, hi Rakida. So, any question before I start, Rakida?
No, not so
Okay,
far.
no problem. So, today unit aim of this unit is to provide you with a comprehensive understanding of taxation within the context of small and medium enterprises and small and medium practices. So by the end of this unit, I hope you will be equipped with the necessary skills to prepare basic tax computations and advise uh, others on the implications of taxation on decision making. So you're doing your own practice or you're working with someone?
I'm working. I'm working
Oh,
with
you
someone.
okay, working. So have you done any other certification before, like ACCA, AAT, or any?
No, not really, to be honest.
Okay. So you did any bachelor or inter or something like that, or?
Uh, yeah, I did bachelor and my master in science, in finance and accounting.
Oh, okay. So you got some exemptions based on your previous qualification.
Uh, I'm sorry, exemption,
Did you get some exemptions based on your previous qualification and then?
meaning that if some of the courses were removed,
Yeah, that's what I'm saying, that exempt, are you exempt from?
sorry, yeah.
Okay,
Like 6 courses were exempt because of my qualification that I had. So I am left only with 4 courses,
okay,
which 2 of them I already done, and this is my third.
okay. So where are you based on?
Albania, Tirana,
Sorry?
Albania, Tirana
Oh,
city.
Albania. Okay. That's fine. Thank you. Okay, Rakida, this is just for self-assessment. You can check your knowledge, regarding course 10 is confident as possible and 1 is not confident at all. Anyway, indicative content, our today's topic expenditures, which is allowed to calculating taxable, tradable profit basis of assessment for employment income, deductions for employment income, property, business profit, room relief, premium received from the grant of a short lease, property, business losses, tax payable on saving income, tax payable on divided income, tax exempt and profit seeking motive, number of transactions, nature of the assets, existence of similar trading transactions or interests, changes to the assets, the way the sale was carried out, the sources of finance, interval of time between purchase and sale, methods of acquisition. Then tax status of workers, plant and machinery, capital allowance, trading losses, calculating trading profit assessments, loss restrictions, purpose, capital and revenue taxes, direct and indirect, overall structure of the UK tax system, differentiate between tax avoidance and evasion, self-assessment, time limits for returns payments, calculation of payments on account, scope of national insurance, calculation of classes of insurance 1A, 2, and 4, and penalties for late returns. Right, I'll just try to explain you in my own words. Okay, so uh, taxation of taxation and allowances over income tax rates. Any comments on this, Radhika? If you know anything about income tax?
Yes, absolutely. Yeah, I I know this from the personal tax course.
Yeah. Okay. Welcome, Manjula. Manjula Lila? Can you hear me? Okay, that's fine. So Rakida, you can see my screen and can hear my voice as well. There's no issue.
Yes, yes, there's no issue from my side. Everything looks good.
Okay, okay. Right. So income tax, basically tax rates in the UK are progressive, uh, meaning higher rates apply to higher income levels. The basic rates and thresholds for different income levels are, as you can see here. So basic rates, £1 and 37,500 pound in tax at 20%. Okay, higher rate income tax, income between 37,501 and 150,000 pound is taxed at 40%, and additional rate income tax over 150,000 pound is taxed at 45%. And then rate, uh, dividend income is taxed at different rates depending on the individual's overall income level. So basic rates taxpayer dividends are taxed at 7.5%. Higher rate taxpayers dividends are taxed at 32.5%. Additional rate taxpayers dividends are taxed at 38.1%. Personal allowances and adjustments. The personal allowances is the amount of income an individuals can earn between before paying income tax for the current tax years. The personal allowance is 12,500 pound. But this allowance decreases for individuals with adjustments in net income over 100,000 pound and is completely eliminated for income over 125,000 pounds. Residence status. So determining residence status is essential for tax purpose as it's dictates the individual's liability to tax. UK tax residence is primarily based on the number of days spent in the UK and presence of ties to the country. So the rule differentiate between individuals who are automatically non-residents, residents on or demand, resident based on specific criteria, including the number of days spent in the UK and the presence of UK ties. Child benefits and income tax, charge. Individuals receiving child benefits face an income tax charge if their income exceeds 50,000 pound. The charge is 1% of the benefit for every 100 pound of income over 50,000 pound, increasing progressively until the benefit is fully taxed. Car benefit percentage, car fuel benefits, company van benefits, individual saving accounts or ISA or property income. So benefit for allowances is taxations. Uh, car benefit companies, car benefits are taxed based on the car's CO emissions and its price, list price. So the taxable benefits percentage increases within higher CO2 emissions, ranging from 16 to 23%, as you can see here. So for petrol cars with emissions up to 95 gram per kilometer, the fuel benefit is calculated based on a fixed figure and added to the taxable car benefits. Company car benefit, employees receiving company vans, car benefits are taxed based on the car CO emissions and list priced. Company van benefits. Employees receiving company vans are subject to a flat rate scale charge, so which is 3,430 pound for the current tax year. Additionally, there is a van fuel benefit charge of 655 pound. Uh, if the company provided fuel for private use alongside the van. So ISA investment saving accounts. ISA offer tax efficient saving and investment opportunities up to an annual limit of 20,000 pound per individuals. Income and capital gains within ISA are tax-free, making them a popular choice for individuals seeking to save or invest without incurring additional tax liabilities. Property income for residential property owners, a basic rate restrictions applies to 75% of finance cost related to their property. So this means only 75% of mortgage, interest, and other finances costs are deductible. So against rental income, with the remaining 25% receiving a basic rate reductions. Pension scheme limits. Annual allowances for pensions. The annual allowances determines the maximum amount of contributions that can be made to a pension scheme each year while still receiving tax relief. For most individuals, the annual allowance is 40,000 pound. However, a minimum allowance of 10,000 pound applies to a high earns with income over 150,000 pound. Contributions that qualify for tax relief without any earning must be not exceed 3,600 pounds annually. Approved mileage allowances. Employees and self-employed individuals can claim tax relief on business mileage using approved mileage rates. These rates are applicable based on the number of miles driven. Up to 10,000 pound miles, 45 pence per mile. Over 10,000, 25 pence per miles. Capital allowances, rates of allowances. Capital allowances provide tax relief on qualifying capital expenditures such as plant and machinery used for business purpose. They are categorized into main pool and special rate pool allowances. So main pool allowances generally 18% on reducing balance basis. Special rate pool allowances typically 6% on reducing balance basis. Then capital allowances, rates allowances for motor, capital allowances for motor can cars depend on their CO emissions. A new car with CO emissions up to 50 gram uh, per kilometer, 100%. Then between 51 and 110 gram per kilometer, 18%. And then CO emission over 110 gram per kilometer is 6%. Annual investment allowances, cash basis accounting, and tax rates. So annual investment allowances, the AIA provides businesses with tax relief on qualifying capital expenditures and plant and machinery, or for plant and machinery. So for the current period, the AIA rate is 100%, allowing businesses to deduct up to 100,000 pound from their taxable profits. Cash basis accounting. Small businesses can option for cash basis accounting if their revenue does not exceed 150,000 pound. This method simplifies accounting by allowing income and expenses to be recorded when they are received or paid. rather than when they are earned or incurred. A cap on income tax relief. Uh, Income tax reliefs are generally capped at the higher of £50,000 or 25% of an individual income, unless specific restrictions apply. Next is corporation tax rates. They determine the amount of tax payable on company profits. Financial years 2019, 18 and 17. So 19 standard rate applies with specific thresholds and limited for registrations and deregistrations. Financial years 2018 and 17. Similarly, standard rate structures apply based on profit thresholds and specific financial year regulations. Value added tax is consumption tax applies on goods and services at each stage of productions and distributions. The standard rate is currently here it is at 20%, with specific thresholds and limit for registrations exemptions based on turnover. Inheritance tax rate is levied on the estate of a deceased person and is charged at different rates. Nil rate based up to 325,000 pound is exempt from inheritance tax. Residential nil rate based additional allowances for residential properties passed on to direct descendants. Rate of tax on excess, the rate is 40% on the amount exceeding that nil rate, a band, and any applicable additional allowances. All good? Everyone can hear me?
Yes,
Can see my screen? Okay.
everything.
Okay. Capital gain tax and national insurance contributions. Capital gain is applicable when an individual or business dispose of assets that have increased in value. So the rate and exemptions vary based on the type of assets and the taxpayer's income. Normal rate is generally 10% for most assets, but 20% for residential property. Lower and higher rates applied depending on an individual's total income and the type of assets sold. Annual exempt amount £12,000 is the threshold up to which gain can be made tax free each year. Entrepreneurs relief and investors reliefs. These reliefs provide lower rate of CGT 10% on qualifying businesses, assets, and investments subject to specific conditions. National insurance contribution or NIC numbers are contributions paid by individuals and employers to fund state benefits and pensions. The rate and thresholds vary depending on the type of NIC and the individual's income. Class 1 contributions employee rate range from 0 to 12% depending on income level, with the thresholds of 8,632 pound per year. Employees rate range from 0 to 13.5% on earning above 8,632 pounds per year. So class 2 contributions flat rate per week for self-employed individuals below a specified profit thresholds. Class 4 contributions, a percentage of profit for self-employed individuals applicable above certain profit thresholds. Interest rates and standard penalties for errors. So, additional considerations for tax matters include rates of interest for underpaid and overpaid taxes, which impact the financial implications of tax liabilities. Standard penalties, when we talk about standard penalties imposed on the severity of and nature of errors or non-compliance. So ranging from 15 to 100% of the tax due, depending on whether the error was careless, deliberate but not concealed, or intentionally and concealed. UK tax system. Uh, UK tax system is complex framework. You from sorry, Manjula, you are based on UK, or you from outside as well? Okay, Rakida, you from Albania?
Yeah, we work together. Me and Manyota, we work together. We live in Albania, Tirana, but we work for a UK company.
Yeah. So you can,
Can you
so
hear me?
yeah, I can hear you. So basically, you are very much familiar with UK taxation system. Am I right?
Yeah, from our work related, yes.
Yeah.
Since we work in accounting and
That's all.
we
So
do
Manjula,
tax
you,
returns, we are familiar with some, I
that's
would say most of them.
okay. So, uh, the UK tax system is complex, framework governing the collection and management of taxes that fund public services and government activities. This section covers the sources of tax laws, professional and ethical framework of taxations, type of taxes, their structures, and the interaction between UK and overseas taxations. So, sources of tax law, the UK tax laws derives from several primary sources, like direct structure and uh, direct laws passed by Parliament, which from the basis of tax legislations. Then HMRC guidance or tax office guidance, interpretation and guidance provided by HM Revenue and Customs to clarify tax laws and procedures. Then indirect sources, when we talk about indirect sources, including case laws, which results from court decisions and tax related, disputes. So, purpose of the UK tax system, the primary source of taxation in the UK is to raise revenue to fund public services, infrastructures, and government operations. It also serves secondary purpose such as redistributions of wealth and influencing economic behavior through incentive and incentives, disincentives. So, professional and ethical framework. So, tax professionals, including accountants and tax advisors, adhere to professional and ethical framework that emphasize integrity, transparency, and compliance with tax laws. So, this ensures that taxpayers receives accurate advice and support in managing their tax affairs responsibly. Type of tax and structures, the UK tax system comprises various type of taxes, including direct and indirect taxes. So direct taxes, uh, anyone can comments on direct taxes? Radhika, you can
Yes.
you hear me, Radhika?
Yeah, you there some I cannot hear you pretty well.
Yeah. So
If
direct
you can
taxes,
cut me off, yeah.
any comments? Yo, that's fine, no problem. But I'm just asking if you know then. So direct taxes such as income tax, corporation tax, and capital gain taxes, okay,
Yes, yes.
applied directly on individuals and businesses based on their income profit. Indirect
Mm-hmm.
taxes, yeah, indirect taxes, uh, like for example, VAT, value added taxes, okay.
Yeah, I know.
Customers duties and excise duties apply to goods and services at the point of consumptions or importation. So explain the nature and purpose of self-assessment tax. Basically, self-assessment is a fundamental system employed by HM, Revenue and Custom uh, in the UK for the collection of income tax. So this system is uh, important for individuals and businesses who earn income that is not automatically subject to tax deductions from sources like wages, pensions, or saving. Instead, those with additional sources of income must report these earnings annually through a tax returns. In the context of self-assessment, individuals and businesses are responsible for accurately reporting their income, calculating any tax liabilities, and submitting this information to HMRC by a specified deadline. So this process ensures that all income, including from sources like self-employment, rental properties, investment, and other form of income is accounted for and tax opportunities. Self-tax returns typically cover a tax year within the UK runs from 6th April to 5th April. So the following year. So for example, the tax year 2021 uh, spans from 6th of April 2020 to 5th of April 2021. So during this period, taxpayers must compile their financial informations, compute any tax due based on applicable rates and allowances, and submit their returns either online or by paper as per HMRC guidelines. A self-assessment serves as mechanism not only for collecting taxes but also for ensuring compliance with tax laws and regulations. It empowers taxpayers to manage their tax affairs, uh, proactively maintain accurate financial record, and meet their obligations to HMRC in timely manners. Sole traders and partnerships, sole traders and partnership represent a common form of businesses ownership where income tax and capital gain tax rates applied based on specific rules and rates applicable to business earning and asset disposals. Income from businesses and gains on disposal of businesses assets. So income from businesses for sole traders and partnerships income primarily arise from trading profits. So these profits encompass revenue generated from business activities after deducting allowable expenses related to running the business. Such income is categorized separately from personal income for tax assessment purpose. Capital gain tax. Uh, Gains realized from the sale or disposal businesses assets within sole trader or partnership operations are subject to capital gain tax. So this tax is calculated based on the difference between the disposal proceeds and the assets acquisition cost, adjusted for any allowable expenses and reliefs. Understanding the distinctions between businesses income and personal income is important for sole traders and partnership. So it ensures accurate reporting and compliance with tax laws governing how trading profit and capital gains are assessed and taxed annually. Tax years and financial years. Tax year is in the UK aligned with the period from 6th to 5th of April, the following year. As you can that see here. Financial years runs from 1st April to 31st March. These timelines dictate when tax liabilities are calculated and when tax returns must be filed with HMRC. So, the UK taxation framework is governed by legislations enacted by the UK Parliament, administered by HMRC, and supplemented by various, statutory instruments, case laws, and extra statutory concessions and HMRC statements of, practice. Uh, Legislations and statutes, the fundamental rules and principle of UK tax laws are codified in, legislations passed by parliaments. These legislations undergo, amendments and uh, undates annually through finance acts, which introduce new tax policies, rates, and regulations. Then HMRC administration plays a central role in administering and enforcing UK tax laws. It is responsible for collecting taxes, ensuring compliance, and providing guidance to taxpayers and businesses on their tax obligations. Tax planning, avoidance, and evasion. So, tax planning is a very clear over here. Legal use of tax legislations to minimize tax bills. Basically, tax planning involves the strategic use of legitimate uh, provisions within tax laws to minimize tax liabilities. Tax avoidance, legal use of tax legislations but not following intent of the law. Tax avoidance also involves using legal provisions within tax laws, but typically involves exploiting intended loopholes or technicalities in the legislations. Tax evasion, illegal way to pay less tax. So this is a very important, and this is a completely illegal. So tax evasion is a stark contrast, is illegal and involves, intentionally misrepresenting or concealing income, assets, or transactions to evade paying taxes on. So it encompasses activities such as underreporting income, inflating expenses, hiding assets in offshore accounts to evade detection, or submitting false documents to tax authorities. This is for your own knowledge. I need your attention on this self-assessment registration form. You can visit tax services government and you can see performer of tax return or self tax returns. This is record tax returns, payments, submissions, notifications, due date, inquiries. Uh,
We cannot hear you anymore. I don't know. I think something is wrong.
which one is it?
Oh, were you speaking just now? Because we couldn't hear you
Can't
about
you
the
hear?
self-assessment.
Can't you hear me?
Yeah, now I can. Yeah, but you were saying about the assessment form.
Oh yeah, this is a performer basically. I was talking that self-assessment registration form. You know that it's a VAT return or tax return which you fill online or pay in a paper shape. So this is a performer basically, you know,
Got
for your
it.
knowledge. If we, so you know that this is you can see here errors, penalties, and late submissions. This is for if you here go through the tax services UK government's. Okay, so you can go to the HMRC Tax Services website. You can see the performer, for a sample or performer where is tax returns details, or you can see a form like this. Can you see here? Okay,
Yeah, yes, yes.
this
Sorry,
is
my
basically,
internet is
yeah, you
difficult.
might
Yeah,
seen this before because if you are working, okay. This you need to fill online. So basically, this is, I will quickly go through. This is basically for your test or your for learning. Okay, test your learning. Uh, due filing date and, different dates and answers. So then you go to explain what charges will made on the taxpayers. And here, test your, here is the answers. Okay. So due date is 31st of March 22, and this is a payment account will be calculated as 50%, and tax payable for which year. This is a basically performer for as an example for your test or for your understanding. Okay.
Yes, got it.
And I hope you felt, Radhika, this if you're working for a tax return as well, and you might seen before as well. Taxable amount and calculate tax payable for a given scenario. So you just calculate, various tax for 2019 was as follows: liabilities, pay, tax deductions, capital gain tax. So his tax for as follows: income tax liability 8,000, deduction deducted a source from employed income 2,500, capital gain is £1,000. Yeah. Complete self-assessment tax returns from given data. So data is there, so you need to complete if you know that. Basically, again, this is a performer. This is just a sample of form for your knowledge. Okay. So I'll come here. Yeah, I will explain here, that further from page 28 in detail. So returns here, that performer is there just for your knowledge and for your, reference. And here will detail regarding returns and further, penalties and everything. So in the, can you hear me, Radhika or Manjula,
Yes,
both?
yes.
No issues. Just let me know, Radhika, if there's any issue, okay? By voice or
Absolutely. Sorry,
okay.
because earlier my internet was pretty bad and I couldn't hear you.
Okay, okay.
Now I
Oh,
can hear you. Is everything okay?
okay, no problem. So, in the context of tax returns, adhering to the deadline set by HMR, and customs, is important to avoid penalties. So, the filing date for submitting a tax returns online is 31st January, following the end of the tax year that the returns cover. So, this means that for the tax years ending on 5th April 20 2023, the online tax return must be filed by 31st of January 2024. So if an individual's prefers to file a paper return, the deadline is earlier, specifically 31st of October following the tax years. Therefore, the tax year are ending on 5th of April 2023, a paper returns must be filed by 31st October 2023. Additionally, uh, 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 the tax years ending on additionally, if HMRC issues a notice on notice to file a return after 31st October following the end of the tax year, the taxpayer has 3 months from the date of issuance to submit their returns. So a failure to meet these deadlines result in, penalties. So you can see penalties here. The initial penalty for late filing is £100. If the return is more than 3 months late, an additional penalties of £10 per day is applied up to maximum of 90 days. If the return is more than 6 months, but not more than 12 months late, the penalty is 5% of the tax due within a minimum of £300. So for returns more than 12 months late, the penalties escalates based on the nature of the delay. 100% of the tax due if the delay is deliberate and concealed. 70% if intentionally but not concealed, and 5% otherwise, with a minimum of £300 in each case, such as in case of carelessness. Understanding these deadlines and penalties is essential for taxpayers to avoid unnecessary financial burden and ensures compliance with tax regulations. Penalties for errors in tax returns are imposed when inaccuracies are detected. These errors can be categorized based on the taxpayer's behavior, carelessness, deliberate errors without arrangements to conceal, and intentionally errors with arrangement to conceal. So the amount of penalty is determined as percentage of the potential lost revenue, or PLR, which is the tax unpaid due to error. The penalties are structured to encourage voluntary disclosure of errors to HMRC, offering reducing penalties for prompt and unprompted disclosures. uh, Penalties for late notifications are imposed when an individual fails to notify HMRC, Revenue and Customs of their chargeability of tax by 5th of October following the end of the relevant tax year. So the amount of penalty is determined based on the potential lost revenue, or PLR, due to the delay in notifications. The penalty structures are designed to encourage timely and accurate notifications to HMRC, with varying, degrees of severity depending on the nature of the delay and whether the taxpayer made any effort to disclose the issue voluntarily. So here you can see maximum of penalties: careless 30%, deliberate but not concealed 70, or deliberate and concealed 100%, prompt and disclose 10%, 20%, 30%, prompted disclose 20, 10, 35%, and 50%. So basically, for deliberate and concealed delays, the maximum penalty is 100%, okay, of the PLR. If disclosed unprompted, the penalty can be reduced to 30%, and if disclosed prompted, it can be reduces to 50%. The higher penalties for concealed delays underscore the severity of intentionally hiding tax obligations from tax office or HMRC, yet still provide an incentive for voluntary disclosure to reduce the penalty. Record uh, keeping requirements: maintain accurate and comprehensive record is important for companies with tax regulations. Taxpayers must keep the record for specific periods depending on their circumstances. In journal, records must be kept until the later of two possible, dates: 5 years after the 31st of January following the tax year by concerned, whether the taxpayer is in business or has rental income, or 1 year after the 31st of January following the tax year. Uh, Otherwise, failure to keep records could lead to penalty of £3,000 for each tax year concerned. So basically, this penalty serve as a strong deterrent against poor record keeping practices and underscore the importance of maintaining detailed and accurate financial record. Payment of tax in the UK tax system: the payment of income tax involves specific deadlines and requirements that taxpayers must adhere to in order to avoid penalties and interest charges. These payments include payments on accounts and the final payments of income tax. So payments on account must be made on 31st January in tax year and on the following 31st July. The following final payment of income must be paid on 31st January following the tax years. Payments on accounts if the prior year's income tax payable fails below £1,000 or if more than 80% of the prior year liability was made through tax deducted off at source. So payments on accounts are not required. The exemptions helps to reduce the administrative burden on taxpayers with lower tax liabilities or those who have already had the majority of their tax deducted at sources. Additionally, taxpayers can make a claim to reduce their payments on accounts if they believe that their tax liabilities for current year will be lower than the previous year. These claims must be made to tax office or HM Revenue and Customs, and the taxpayer must specify the reduced amount or claimed nil if no uh, payment of accounts or POAs are required. It is important to make accurate claims as underestimating the liabilities could result in interest charges and penalties. Interest and late payment of taxes. Penalties and interest are imposed on taxpayers who fail to pay their income tax, class 4 national contributions, or capital gain tax on time. So the penalties are designed to encourage timely payments and compensate for the delay in tax collections. So interest on late payments accurate from the normal due date for POAs or payment of accounts. These dates are 31st January and 31st July. So if the tax remains unpaid after these dates, interest will be charged on the outstanding amount. Similarly, interest on any final payment and CGT capital gain tax begins to accurate from the due date, which is 31st January following the end of the tax year. Ethical issues in tax work. Uh, Ethical issues considerations are paramount. The actions and decisions of tax professionals not only impact their clients but also have broader implications for compliance with tax laws and the integrity of the tax system. HMRC evaluates several factors to determine whether certain activities constitute trade and whether the ethical boundaries of tax practices are being observed. One of the key factors considered by HMRC is the subject matter of transactions. This involves examining the nature of the asset in questions. For example, if an asset is purchased not for personal or investment purposes but in as a stock or inventory, this indicates that the activity may be classified as trade. Okay, so this distinctions is critical because trading activities are subject to different tax treatments compared to personal or investment transactions. Uh, Supplementary work, improvement, advertising, circumstances of acquisition, realizations, and motive. The name of supplementary work or improvement made to an asset can significantly influence its classification for tax purposes when an asset is acquired and subsequently enhanced before being sold. This indicate a trade enhancement often add value to the assets, making it more likely that the intent behind the transactions was to generate profit through trading activities. Uh, Advertising and promotional activities associated with the uh, uh, with the sale of an assets can also indicate trading activity. If significant efforts is put into advertising an asset to increase its marketability and price. It suggests an intent to conduct trade. So the presence of a profit motive is a strong indicator of trade, as the primary objective of trading activities is to generate profit. A use mnemonic is a software like subject, ownership, frequently, improvements, reason of sales, and motive. So, a subject matter, the nature of the assets, asset bought on stock as inventory indicate trade, ownership, ownership length, a brief period of ownership suggests trade, frequency of transactions, frequently transactions imply trade, improvement, improvements, enhancement made to an asset indicate trade, a reason for sale, the motive behind the sale, such as a profit making suggests trade. So finally, motive, a profit motive strongly indicate trade. So when an activity is classified as a trade based on these factors, the resulting profits are taxed as trading income. So this classification has significant tax implications, as trading income is subject to different tax rules and rates compared to other forms of income such as capital gains. All good? Any questions, any concerns, any issues? Can you see my screens? Can you hear my voice?
Yeah, yeah,
Everything is
all good.
okay? Okay, okay.
Everything clear.
Okay, you okay, Radhika? Rakida, sorry.
No
And
worries.
Manjula, are you okay as well? Okay, okay. So, okay. So, oops. Adjustments of profit or pro forma, similar to companies, but some important differentiates. Net profit per accounts, disallowable expenses income, but taxable is trading, less income including but taxable as trading income, expenses not as account but allowance, so less capital allowances. So will come out with trading profit. So disallowable expenses will explain over here. In the context of unincorporated business such as sole traders and partnerships, certain expenses cannot be deducted when calculating taxable profit. So this disallowable expenses are similar to those for companies with a few exceptions. Private expenditures incurred by the business's owner are disallowed. These may be estimated as percentage and agreed upon with HMRC. In contrast, private use of an employee is allowable. Adjustments for private expenditures involve adding back any disallowed amount to the business profit. So this ensures the personal use of businesses resources does not unfairly reduce the taxable income. Salary of proprietor, uh, payment made to the proprietor, whether labeled as salary or drawing, are treated as appropriations of profit. So these are equivalent to dividends in company structures and are therefore disallowed for tax purpose. They must be added back to the profit in the tax computation. Sole traders own income tax and class 2 and class 4 insurance contributions are similarly disallowed. Journal provisions, unincorporated business are not subject to the Companies Act requirements. They can make journal provisions in their accounts, especially for bad, impaired to irrecoverable debts. However, movement in these provisions must be adjusted for tax purposes. An increase in the journal provisions in disallowed, meaning it must be added back to profit, while a decrease in the journal provisions is not taxable and should be reduced from profit. So this treatment ensures that only realized, gains or losses impact the taxable income, maintaining a clear distinctions between accounting provisions and actual financial performance. Items not included in the accounts, income not included, but taxable goods taken by the owners for their own use. So certain incomes are not included in the accounts but are taxable. For example, goods taken by the owner for personal use need to be accounted for as if they were sold to a third party. So the trader would have made a profit if the goods were sold rather than taken. Therefore, the profit element need to be taxed if the drawing has already been accounted for, only the profit element is added. If not accounted for, the full selling value of the goods taken must be added to the taxable income. So this ensures that personal use of businesses resources is appropriately taxed. Expenses not included in the account but allowed. Business expenses paid privately are allowable for tax purpose. These must be deducted in the adjustment to profits computation. An example is the use of home as an office, where a portion of household expenses can be claimed as a business expense. So this deductions ensures that legitimate business expenses, even if paid from personal funds, are recognized in the tax calculations, providing a fair assessment of the taxable income. Taxable allowances, capital allowances, and private use assets. For uh, incorporated businesses, capital allowances are compared similarly to companies, but with adjustments for private use by proprietors. Each assets must be recorded in a separate column. The capital allowance is calculated normally and deducted from the column. The actual allowances claimed is only for the business use proportions. Private use assets, commonly cars, required careful consideration of the appropriate WDA or written down, allowance based on the car's CO emission levels. So the approach ensures that only the business related depreciation is claimed, maintaining accuracy in the tax deductions. Basically, this is a disposal and balancing charges. Right. So upon disposal of an assets, a balancing or a balancing charge or balancing allowance applies. Only the business use proportion of the balancing charge or allowance is taxed or allowed. So private use assets, often cars, requires particular attention to the WDA written down allowance based on CO emissions. If the trader takes the car cover from the business, it is considered a disposal at market value. The deduction is the lower of the original cost and market value. This treatment is common upon cessation of business and ensures that private benefits uh, derived from businesses assets are appropriately taxed. Uh, Maximum AIA and WDA adjustments. AIA, annual investment allowance, and WDA, obviously writing down allowances, must be adjusted according to the length of the accounting period. For long periods of accounts, one capital allowance Competition is prepared for the entire period and the allowances are scaled up. Unlike companies, this period is not split into two. First year allowances are never time apportioned. This method ensures that capital allowances accurately reflected the usage of assets, cover the accounting periods, maintaining fairness in the tax treatment. Trading allowances of £1,000 is available exclusively to sole traders. If a sole trader's trading income is no more than £1,000, it is exempt and need not to be declared. So if the income is less than £1,000 but not expenses are higher, the trader can choose not to claim the trading allowances to obtain relief for a trading loss. If trading income exceeds £1,000, the trader can option to deduct the trading allowances rather than actual expenses. This allowances simplifies tax reporting for small scale traders and ensures that minor trading activities are not overburdened with tax compliance requirements. Income tax returns self-employed we discussed previously as well. Taxpayer must complete the main tax return and relevant supplementary pages. Only the supplementary paper pertinent to their circumstances need to be filled out. There are 6 supplementary pages for self-employed with pages 2 potentially or appearing in the real assessment. It is important to complete the forms accurately, ensuring all figures are entered in the correct boxes. Marks are awarded for correct entries, and it is not necessary to fill in boxes with nil or zero. The key is to ensure that all required information is provided accurately to avoid errors in text calculation, calculation, calculations. So key points of real assessments. In real assessment, it is important to remember that left hand column is usually pre uh, filled. Figures must be entered the correct boxes, and marks are given for correct usage. One page or part of a page of any tax form is typically required to be completed. Most figures are provided, but must calculations such as total disallowable expenses may be necessary. Accurate completion of these forms ensures proper tax assessment and compliance with HMRC requirements, preventing potential penalties and ensuring that the taxpayers' obligations are correctly. Here you can see, performer of self-employment blank page. So you need to fill all of, total expenses and disallowable expenses. Tax residents, UK and non-UK residents. Tax residence is important concept in determining an individual's tax liability in the UK. The resident status affect whether an individual is subject to income tax on UK or overseas income or just UK income. UK residents are liable to pay income tax on their worldwide income, whether non-residents are only liable for income tax on their UK income. So the determination of resident status follows of tests in a specific orders: automatic non-UK residents, automatic UK residence tax, and consider the number of ties and number of days spent in the UK we discussed earlier as well. Automatic non-UK residents test identify individuals who automatically qualify as non-UK residents. If an individual meets the criteria of these tests, they are considered non-UK residents for tax purposes. For example, if individuals spends fewer than 16 days in the UK during the tax years, they will automatically be classified as non-UK residents. automatic UK residence test if if an individual spend 83 days, 83 days or more in the UK within a tax year, they are automatically treated as UK residents. So consider the number of ties, the number of days spent in the UK. Uh, Ties might include having family in the UK, having a UK home, and working in the UK. So the number of ties and days spent in the UK are evaluated to ascertain whether the individual is UK resident. So these steps ensures that the determination of tax residence through and take into account various factors that may influence an individual's connections to the UK. Domicile domicile is concept primarily relevant for inheritance tax purpose, but can also impact other taxes, and individuals' domicile status is distinct from their residence status and is based on their long-term home and intentions. The rules for determining domiciles are, you know, uh, there are different type of domiciles, like a domicile of origin, domicile of dependence, and domicile of choice. So domicile, when we talk about domicile of origin, requires father's domicile at birth. So domiciles of dependence until the age of 16, any change of the individuals, this period is referred to the domicile of dependence. Then finally, domicile of choice. Once an individual's reach the age of 16, they can establish a new domicile known as a domicile of choice by moving to a different country and intending to resident there permanently. So deemed domicile. Yeah, from 6th April 17, new rules allows for individuals to be deemed domiciled in the UK for tax purposes under certain conditions. So this means that even if an individual is technically non-domiciled, they will be treated as UK domiciled if they meet one of the, these following conditions. Condition A and B. A is individual was born in the UK. Individual has a UK domicile of origin. Individual was a UK resident in the tax year 17 and 18 or later. Condition B is the individual has been a UK resident at least 15 years out of the 20 tax years immediately preceding the current tax years. So basically, these conditions ensures that individuals who have strong ties to the UK, either through birth or prolonged residence, are treated as domiciled in the UK for tax purpose. So this affects their liability to UK tax or their worldwide income and inheritance tax on their global assets. All good? Any issues? Any concerns? Questions? Can you see my screen, voice?
Yeah, all good. All good.
I know you're getting tired or bored, but just nearly finished, just a couple of pages, so don't worry.
Yeah, no problem. No
Okay.
problem.
This lecture is bit longer than some other lectures, so because it's the first lecture, so they're explaining everything like even domicile or UK residence, conditions or stuff like that. So taxable and exempt income be categorized into taxable and exempt type. So each having different implications for income tax, computation. So taxable income included all sources of income that are subject to income tax. When calculating income tax, it is essential to include all taxable income in all computation. This includes like wages, interest, dividends, rental income, and other sources that contribute to the total taxable income. So the tax computation involves summing uh, all these sources to determine the total income on which tax is payable. Exempt exempt income income from individual saving account or ISA, gambling and lottery winnings, premium board prizes, any prizes won from premium boards are tax free. Most social security benefits like government benefits, these benefits provide financial supports to individual in need. So interest or saving certificates, interest on save as you earn, statutory redundancy pay, payment received as a statutory residency pay are exempt from income tax. So this is the compensation provided to employees when they are laid off due to redundancy. So interest on delayed income tax repayments, any interest earned on delayed income tax repayment is exempt from income tax. Scholarships and educational grants, any amounts received as scholarship and educational grants are not subject to income tax, encouraging education and learning. Damage received on injury or death. So, compensation received as damage for injury or death is exempt from income tax, providing relief in such circumstances. Grossing up. Yeah, grossing up is a process used to state income as its gross amount. For example, before any tax has been deducted, this is important for inaccurate tax computation. So, yeah, as all income must be considered at its gross value to determine the correct tax liability. Different type of income requires different statements when grossing up, like salaries, interest, and unquoted companies, loan noted, all other income. Salaries are typically presented at their gross figure in questions and financial statements. This means there is no need to add it back the tax that has been deducted. The gross salary is used directly in the tax computations. Interest on unquoted companies loan notes. Interest on these loans notes is usually received net of income tax, with tax at a rate of 20% deducted at source. To gross of these income, multiply the net amount received by 100 divided by 80. So this adjustment ensures the full amount before tax deduction is included in the income tax computation. So finally, all other income uh, for other incomes for of income that are received gross, for example, no tax deducted. The at sources, the amount received is the taxable amount. No further adjustments are needed in these cases. So here again, whatever we discussed above is introduction to the income tax computations, gross income and net income. So that's it for today. Here are some references, and for further reading, you can visit your learning Moodle or learning management system. You might can have you will have some books over there as well. Thank you very much, everyone. Any questions, concerns, and issues? Uh,
Thank you.
all
I
good.
was just gonna ask about the assignment for business
Uh,
taxation. Do we
this
have
is
it around
our
12 o'clock?
yes, Ritika, this is our first session. So in our last section, we will discuss assignment as well. Okay.
Okay, I just wanted to be organized with the tasks. They usually send me in since the beginning, but it's okay for me. No
Have
problem at
you,
all.
no, no, have you received any assignments or not yet?
For business taxation, no. But when I
Okay,
started to
okay.
use
What will
that,
happen that you can email to Jill and I'll mention there as well. Okay. First thing in the Monday morning, I will speak to
yeah,
her regarding your assignment brief, and you will get your assignment brief as well. Okay.
okay, perfect.
I-
Thank you so
I'll
much.
just make a note here. So you will get your assignment brief by Monday, okay? But normally what happens, you have a plenty of time. I mean that this tomorrow we will there is our second session, and next weekend our third, and uh, I think so next Sunday will be our last session of business taxation, which will be a assignment session. And then after you can
Yeah.
start your assignment and you will get assignment brief as well. But I'll make sure you get your assignment
It's okay.
brief within
That's also
coming week.
fine.
Okay?
We can
Okay?
also wait. We can also wait until we finish all the seminars together, and then when we discuss the assignment discussion, we can also receive the assignment brief. It's okay for me. I was
Yeah,
just used to
yeah,
from
no,
my previous
don't
work.
worry, Radhika. You will get your assignment by next week. Okay? I'll make sure that you get your assignment by next week. Okay?
Thank you so much.
Yeah, okay, don't worry. Any other questions? So any questions, any concerns, you guys can drop me an email at yasir@ukversity.co.uk. Thank you very much for joining me today,
Thank
and our
you.
next session will be tomorrow at 12 o'clock, same time tomorrow. Okay?
Okay. Thank you. Have a
Okay,
nice day.
thanks. Thank you very much, everyone. And bye for now, and see you tomorrow at 12 o'clock. Okay, bye now.